Welcome to the TrustleBridge Capital Market Observations Call for August 15th. I'm your host, Eric Jefferson, Managing Partner with TrustleBridge. A lot to talk about today, although before we get started, I have a few quick words from our legal team. With that, go ahead and dive right in. I would like to start, as we do, by quickly recapping markets. We've seen both stocks and bonds now trade roughly 3% off their recent highs. And when we think about what's driving this, and we're now a majority of the way through earnings season. And so here's where we typically see a return to the macro data, the fundamentals as taking over or being in the driver's seat as far as what is impacting prices. Very recently received three key points that I'll spend a minute or two quickly going through. First up is with respect to the US consumer. We've talked about the importance there. They represent roughly 70% of the US economy. And earlier this morning, we received retail sales data. That is a measure of how much the consumer is going out and spending. And as we've seen throughout the course of this year, the consumer has once again demonstrated their resiliency. Those figures came in above expectations, certainly an encouraging sign for our economy. Now, one of the narratives we are watching very closely, particularly with the pandemic era savings being depleted, is increasingly more and more being spent on credit cards. Last quarter alone, credit cards registered over 1 trillion in sales. That is the largest figure that it's ever been. Not surprisingly, with more credit card usage, you're starting to see an uptick in delinquencies. We now have just over 7% of accounts are greater than 30 days overdue. That figure represents an 11-year high. Now, one statistic certainly doesn't change our view on the consumer, but if that trend were to continue, could at some point become worrisome. That is also on top of the fact that beginning next month, recess for student loan repayments is officially over. You recall during the pandemic, there was a program to halt those cutbacks have since expired. We'll see those payments resume. For the average borrower, represents $400 a month. So we think about that 22 to 35-year-old demographic. That is going to have a direct hit on the discretionary dollars left over each month to then go out and spend. Net, that is obviously somewhat of a headwind. But more importantly, we think about what ultimately drives a consumer's willingness to spend. It's, are they able to earn? The labor market still remains very much in favor of the worker as opposed to the employer. Unemployment still near all-time lows, granted, have started to see some softening, but at least for today, folks that want to work can go out and get jobs. More importantly, consumers believe they are able and will continue to be able to go out and work. That's ultimately what gives them the confidence to spend. One interesting stat, though, going back to student loans, over the last 15 years, where that has absolutely ballooned, now become the second largest segment of the credit market behind mortgages. Put differently, there's now more student loan debt out there than there are auto loans or credit cards. Interesting stat when we think about how some of those spending priorities have shifted in the last decade and a half. Moving on, next point recently came in, everybody's favorite topic. That is, of course, inflation. I received the July price or CPI levels. That is the measure of consumer prices. And once again, those continue to increase, but at a much slower rate. That is a sign of progress, at least on the headline level. The core CPI, or the stickier components that aren't as volatile month to month, those have remained very resilient as well at 4.8%. That is unchanged and still represents a significantly higher level than the Fed's long-term average and target of 2%. Not surprisingly, that has now fueled the higher for longer narrative. That, of course, refers to interest rates, which have been raised in order to combat inflation. This very resilient, sticky component of inflation suggests still a great bit or a great deal of work still left to be done or needed before the Fed could even start to think about declaring victory and entertain interest rate cuts. On the short term, somewhat of a cautionary outlook. We've seen energy prices tick up as of late. That's a function of Saudi Arabia cutting oil supply. As well, a series of health cut subsidies set to expire at the end of this month. That will also have an uptick, at least in the short term, on prices. Over the intermediate and longer term, we do have very encouraging trends, although, as we know, nothing happens overnight. Will certainly be the focus for the next quarter or two, seeing how those two offsetting forces will balance each other out as it relates to the prospect or possibility of additional interest rate hikes. The third piece that I want to focus on for today comes out of China, particularly their growth, which has underwhelmed relative to expectations. Obviously, China was the last to reopen following COVID. Everyone expected a big boom. We have seen that in some segments of the Chinese economy, but overall has been weak data point after weak data point. That has in turn had their government issue several rounds of stimulus. Unfortunately, though, at least to this point, to no avail. That is concerning for two reasons. One, particularly with some of the real estate developers in their country, have started to have some concerns with respect to their creditworthiness or ability to repay loans. Real estate, much larger segment of the Chinese economy than domestically. Secondly, when we think about slowing growth, obviously that has a net negative impact on overall growth, particularly with countries they trade with, a la the European region. But one encouraging sign, though, is that ultimately does have a deflationary force. Again, China, the largest consumer of raw materials, if they're not growing at a higher than expected rate, they are in theory consuming less. That puts downward pressure on commodity prices and in turn may help offset some of the negativity associated with that slowing growth. Obviously, China being at its targets is a crucial in order for overall growth to hang in there. And as we think about all that needs to happen with respect to labor, with the economy, with respect to growth, markets currently pricing in a lot of good news that needs to come to fruition. Otherwise, it could potentially set us for some volatility. That's all for this week. As always, appreciate you taking the time to join us. Happy to go into more detail, any topics we didn't cover. Have a great rest of the week. Take care.